Welcome on the next episode of Money and Medicine. Today we're going to talk about investments, the fundamentals, the very basics that you need to know before making an investment decision. We're going to look at asset classes. We're also going to look at associated risk, as well as the growth that you can expect in these different asset classes. For those of you who are viewing this channel for the very first time, please feel free to go down to the bottom of this page and subscribe. The reason we started Money and Medicine was as a platform where you can gain as much information as possible to educate yourself in making better financial decisions going forward. So when you look at the different asset classes, it is important to understand that there are four main asset classes in which one can invest. The first, being the most common one, is cash. So cash is basically a money market at the bank, or a 31-day deposit or a fixed deposit where you can invest money. But basically you can expect a growth of about inflation. We'll talk about growth in a moment. The second asset class that one can invest in is bonds. So what is a bond? Well, a bond is a way of an institution raising capital, and they reward you with what is called a coupon, or an interest that they pay back for you. You do get government bonds as well as private institutional bonds that one can invest in. The third asset class, which we're going to talk about, is property, which basically also includes your residential property, but in general, more commercial property as well as industrial properties and indices in which you can invest. And the last, and I think this is also a very common one, which people do invest in as well, is equity. Equity is just a smart word for shareholding. So if one say I've got about a 30% equity in a company A, then it means that I've got 30% shareholding in company A. So let's talk about the risk of each of these asset classes. Well, if you look at a scale from 1 to 5, 1 being the lowest and 5 the highest, cash would typically be 1. Bonds, you're looking at about 2, maybe 2.5, depending on which institution you invest with. Property would typically be about a 3, 3.5, and equity would be a 4.5 to a 5. It's always important to understand that if you do a diversification of these assets, that if you've got more cash, then obviously your diversified portfolio would be more closer to 1. And if you do a higher diversified portfolio with more equity in it, you would be higher or closer to a 5. If we look at the growth of each of these asset classes, it's very important first for us to define what does inflation mean. Well, inflation in essence is if you pay 10 Rand for a bottle of water and inflation is 10%, next year you're going to pay basically 11 Rand for that bottle of water. So it's the value that money loses its power in the future. So we always want to outperform inflation, or at least do inflation if you want to protect your money. So typically cash would perform at about inflation, as mentioned earlier. A bond, you can typically look at it, also again depend on whether you're investing in an emerging economy or whether you're investing in an established economy. But a bond will typically do locally about inflation plus 2%. We've even in recent times seen that it's outperformed inflation by about 3 to 4% in terms of the growth. Then if you look at property, you look at typically about inflation plus 3 to 4%. And then lastly, when you look at equity, it can go anything from inflation plus 5% to even inflation plus 10%. It is important also to note that there is term associated to these potential growths. We don't have a clue of what tomorrow is going to look like. We also don't know what it's going to look like a month from now, 6 months from now. We might have a fair idea, what it's going to look like a year from now. However, based on the past, we've got a very good idea of what 10 years would look and what 20 years would look like from now. So we know that over time, equity would perform as indicated, or over time, property would roughly get what as stated earlier. Or when one take up the diversified or a balanced portfolio, it is important to keep always your term in mind, just to know exactly for how long are you fixing up this money, because you always want to get as much growth as possible for the lowest risk possible. However, you do need to consider that the more growth you want, the more riskier assets you need to include. And the more stability you want, the less riskier assets you want to include. So it's always important to understand that when you do a diversified portfolio, to include a balance, a well-defined balance of these different asset classes over a certain time to get to your desired return or your target return that you've established with your financial advisor. I hope this helps you to make an informed decision. On the next episode of Money and Medicine, we'll talk a little bit about the different vehicles in which one can invest. What is the tax implications on these different vehicles? So that you know before you start investing, what does your underlying assets look like? Do you include stability in terms of a short-term need? Do you include a little bit more growth assets for something that is for retirement? So that you can associate the correct assets with the correct time frame, as well as with the associated risk that you are willing to incorporate. Thank you so much again for tuning into Money and Medicine. If you haven't done so, please go to the bottom of this page and subscribe, and also comment, and feel free to share some information or to share some ideas which can help all of us grow together. Thank you so much.